Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Welcome to Monday. The S&P 500 up 5 points, just a little fraction. 68.21. Dow Jones Industrial Average down 0.5 percentage point, mainly on Goldman Sachs weakness, sitting at 47,649. Nasdaq's up 0.33%, rebound in software stocks and some select mega cap tech buying. Nasdaq's up 0.25% to 22,968. The Russell 2000 up 0.33%, sitting at 2639. We're moving closer and closer to Kevin Warsh being nominated. Well, he's been nominated for Fed governor to replace Jerome Powell. It's expected that when he gets in that he wants to cut interest rates almost immediately, 25 to 75 basis points, to get it at fair value, to worry less about inflation and more about jobs. So we have some gasoline coming for the stock market later this year. Gold a little bit lower, down 1.1%, sitting at 47.32. Bitcoin up 1.7%, sitting at 71,982. 10-year Treasury is stuck 4.32%. I feel that's too high. Uber's facing a second driver sexual assault trial following $8.5 million verdict. Goldman Sachs is warning consumers gas price spike will be felt. Oil is rising today as the U.S. moves to block off the Iran Strait of Hormuz, heightening supply risks. JD Vance did not secure a peace deal, comes home with nothing. Prices are beginning to rise in America faster than American wages. I have a story on tomatoes in just a minute. Tesla's full self-driving gets a Dutch sign-off, paving the way for future European approvals. Interesting. Over the weekend, for the second time in recent days, OpenAI CEO Sam Altman's home was targeted in a second attack. I believe one was a Molotov cocktail and the other was some gunshots. Over 1,000 Hollywood stars are opposing unequivocal opposition to the Paramount Warner deal. It's a pretty fun list of names. Not exactly sure who told these actors that their opinion matters on big corporate affairs, but obviously they're the lifeblood of movie studios. Bryan Cranston, Glenn Close, Ben Stiller, Don Cheadle, Jason Bateman, Ted Danson, J.J. Abrams. Many. I think that's going to be a deal that we look back on and go, wow, we really did lose another big studio, just like we've lost a lot of airlines. So I think the markets are holding up remarkably well. To use the word resilient is almost embarrassingly wrong. When I saw that Trump picked a fight with Pope Leo this weekend, and then the peace deal broke through, bringing up the question of the ceasefire, and Trump positioning military boats for blockade of Iran, Iran's going to be hurting. If that blockade holds, no military weapons, no water, no parts to rebuild, a lot of problems there for Iran. I would think they would crack under pressure, but I've probably been saying that for 3 weeks now. Rory McIlroy secured a second consecutive Masters title and the big surprise pot to date. He's only 36. I feel like I've been watching him for like 20 years. That can't be right, but I guess he's probably been playing since he's 18 or 19. The Masters green jacket pulls in a tidy sum of $4.5 million for the winner, up from $4.2 million last year. Tiger Woods made $1 million in 2001, so that's 2.5 times what Tiger Woods pulled. I did a little work on shopping at the Masters. The Masters merchandise, it can only be bought at the pro shop, nothing online, but certainly resold online. Merchandise includes branded golf gear, beach towels, and more. Hottest items include $88 quarter zip sweatshirts and $50 garden gnomes. This is what's wild. Only open to the public for 1 week of the year. They pulled in $70 million in merchandise. That's $16,000 a minute for one shop. Only 1/10 of the 1/10% of America can get membership of roughly 300. But they did open their gates to the public. Tickets for opening ground were between $100 and $140 via lottery system, but secondary market tickets cost upwards of $1,500 each. Concession prices are shockingly low. Chicken sandwich, soft drink, and a bag of chips under $7. A beer runs $6. Doesn't make any sense. Markets last week capped a wild week of a 3% gain as a fragile 2-week ceasefire in the Middle East triggered a massive relief rally, overcoming a terrifying 1% monthly inflation spike and record low consumer sentiment. The energy trade unwound when oil dipped below 100, but picked right back up this morning when oil got above 100 again. Taiwan Semiconductor delivered a masterclass in AI equipment sales. That was my top pick 2 years ago. I'm pretty proud of that one. My top pick this year is Amazon. I feel very comfortable with that if the markets calm down. Last week, the S&P 500 was up 3.5%. The QQQ is up 4.6%. Healthcare, select sector XLV was up 1/3 So it was a market of winners and losers. The market has been a furious rally with the S&P 500 green for 7 straight days, including a massive 1.8% true up before a modest 11 basis points pause on Friday. A lot of gapping up right now. On a single stock side, the rally has left many names too extended to be tactically attractive, with semiconductors at the top of that list after the largest 8-day rally since 2002. Knocking your socks off, the semiconductor index had its largest 8-day rally since 2002, and 3 times long ETF SOXL was up nearly 100% from its low in 8 days. Semiconductors continue to shrug off any issues, and while we're hesitant to chase them here, the trend and momentum must be respected until it stops. Small cap tech is relative strength right now. New absolute and relative highs for small cap tech, ticker symbol PSCT. Bitcoin and software have been quite correlated over the last couple of years. That started to diverge of late, with Bitcoin bottoming in February and now trying to rally out of a base as software continues to decline. Software's having a great day, though, today. This week, we get earnings from Goldman Sachs today. More on that in just a minute. Tuesday, we get JP Morgan Chase, Wells Fargo, Johnson & Johnson, Citigroup. Wednesday, Bank of America, Morgan Stanley. All of these companies are going to tell us how the consumer's doing. Thursday, we get Pepsi, Charles Schwab, and Netflix. Looking forward to seeing what Netflix has to say. Today, we got existing home sales. More on that in a minute. We're going to get the employment change tomorrow. We're going to get one of the Fed vice chairs speaking. I'm not seeing a lot there. Continuing claims on Thursday. Not the biggest day in the world for me as far as, or not the biggest week as far as economic data. But let's say that existing home sales, they were hurt in March by several constraints. Existing home sales decreased 3.6% month over month in March to a seasonally adjusted annual rate of 3.9 million. The report that I found interesting inside this is that the existing home sales were pressured at the start of the peak selling period by high mortgage rates and higher prices, limited inventory, lower consumer confidence, and softer job growth. The median existing home sales price increased 1.4% year over year to $408,800. 33rd consecutive month of year over year increases. Existing home sales month over month were weak in the Northeast, in the Midwest. The South saw some strength, and the West saw a little bit of strength. Sales up 2.2% in the South, 1.3% in the West. Median home sales, though, grew in the Northeast 5.7%, Midwest 4.9%, South just under 1%, and the West down 1.3%. The median time on the market was 41 days versus 47 in February and 36 a year ago. First-time buyers accounted for 32% of sales versus 34% in February and 32% a year ago. Cash sales represented 27% of transactions versus 31% in February and 26% a year ago. Evercore upgraded a handful of home builders, not on this news. I'm just doing side by side with this news, saying much of the bad news around the sluggish housing market is already priced in. That should limit the downside from here. They went from hold to buy on Toll Brothers and Pulte Group. They upgraded Masco. Masco makes a lot of the plumbing products and paint products like Behr paint that go into our homes, especially when we buy a new home or sell a home. Goldman Sachs reported better than expected first quarter earnings. Stronger investment banking revenues and record equities trading both were highlights. They had a great return on equity. Fixed income was the question mark. But it was a broad-based strength across investment banking, equities, and asset management, reinforcing its position as a top-tier global franchise. Stock's decline underscores how much optimism had been built into the stock market rally. Investors decided to lock in some gains on the beat. The results serve as a bullish indicator for the broader financial sector, particularly for rivals like Morgan Stanley, as improving deal activity, strong client engagement, and resilient trading conditions point to a more constructive operating backdrop in 2026. Best Buy is not having the best day. Double downgrade at Goldman Sachs. Ultimately, their thesis is higher memory prices are going to impact computer sales, and their appliances are struggling. Best Buy has been raising its dividend, but is that going to be able to continue to do that if they have weak top-line revenue growth? Yield right now is about 6%, which is unreasonably high. Goldman Sachs lowered the price target from $76 down to $59 on Best Buy. They didn't just talk about Best Buy, they also talked about Williams-Sonoma today. Upgraded from hold to buy. Shares are down about 14% from their February highs. Basically, the analysts are saying, hey, Rob Black likes it when a tech stock goes 20 to 40% off its all-time highs. That's when he becomes interested. He became interested when Williams-Sonoma came off 14% from their all-time highs. Williams-Sonoma is one of those companies that I believe you can put in your income portfolio for retirement. Now, what do I mean by that? For me, I want my income consistent. My income in retirement is like a paycheck that's going to replace my company that's paying me now. I used to own my own company. I liked this company so much I sold my company to them, merged. Williams-Sonoma yields 1.6% of a dividend yield. In no way, shape, or form is that fantastic. But in the last 5 years, the stock has gone from $56 up to $191. Now, there was the COVID thing in there as well. That's worthy of note. So if you want to go back to, say, 2010, let's say your retirement's going to last 15 years. The stock has gone from $7 to $191, all with a pretty high dividend yield. At this point in time, buying when it's 16% off its all-time highs, if you're buying for that dividend yield with some growth, and the growth has been spotty at times, but consistent over time. 20 times earnings does not make this one feel wildly expensive. Trading at 17 times, 18 times next year's earnings. So it doesn't look crazy. The PEG ratio is pretty consistent. About 2.5. Historically, that holds. Price to sales ratio is a little bit high right now at 3.2. We've seen it as low as 2.5 times when things got rough last year during the tariff tantrum. But that's my idea on Williams-Sonoma. It's an income stock with some growth, historical growth. And I don't think it's going to go out of business. Now, again, there's going to be some presidents like Trump's tariffs that are going to be very problematic for the company. But their brands are unbelievable, in my opinion. And when I say unbelievable, just think about strong brands. I should watch how I word things. BTIG initiated coverage of Adobe with a hold, citing concerns about its long-term revenue and margin trajectory. AI is raising a host of questions about the future of the creative ecosystem. AI disruption worries have also crushed names like Salesforce. So this is part of the software as a service apocalypse. But I think Adobe's business it could have real displacement. I now use video and editing software that's not Adobe. So when I put together this podcast, it's not Adobe. I use an AI editor. It's expensive, all things considered, but I do like it. I'm editing together my kids' video soccer clips for a sizzle reel for coaches. And that too is in a situation where I use video editing software, not called Adobe. And in the past, they were your only choice. I've got a lot to talk about today in software and technology like Tesla, Microsoft, software as apocalypse stocks are turning positive today. Some value names in the world of technology that you may be interested in. You know how I like buying things off from their all-time highs? I got some ideas. I did put some money to work last week. If there's another dip, I plan to put more money to work. I'm being very constructive right now. This is something I'll talk about at our Pints and Portfolios Saturday, April 18th. That's this Saturday, 11:30 to 1:30 in Sunnyvale, California. Tell me what you're buying. I'll tell you what I'm buying. It's a good event because it's Pints and Portfolio. It's all about finding out where you are on your road to retirement. It's ideal for people 50 to 65, 70, either just thinking about retirement or just in retirement. Will you have enough money to last till the day you die? I'm going to bring CFP Ryan Ignacio and CFP Julie Chan O'Rourke. She's one of my favorite people. She's going to become my family CFP when Brad retires. Well, I may just ask Brad to hand her off at some point. He's in his 70s and wants to play golf until he goes up to the big golf course in the sky, if you will. Anyway, big event this Saturday, Sunnyvale, California. It's April 18th, 11:30 to 1:30. I'll buy the beers. Hopefully there's not too much beer inflation. If you're picking up what I'm putting down. I enjoy those events enormously. After all these years, to be able to buy some of my fans and listeners a beer, it's gratifying. Sign up for it at robblackshow.com. I've got 2 more segments coming up. Stay tuned.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
So let's jump back into what's happening on the markets today. I saw one of those whoopsies before I get back into the markets. CNN had to apologize after erroneously publishing a piece titled "Remembering the Life of Michael J. Fox." The Back to the Future actor clarified on social media that he is still alive, posting "WTF, I'm okay," which is probably also how Marty McFly calmed himself down after he kissed his mother in 1955. Beyond Meat sank from a $14 billion plant-based protein powerhouse into a penny stock. That goes to show you that you got to be careful about investing with your morals and your ethics, or your gut sometimes. I think meat's going to be the next thing that goes away, and we're all going to be plant-based. I tried it because I really wanted to be that dad who embraced it, and I found it just not right. And I was trying it in the most simplest way of adding it to a tomato-based sauce, like a spaghetti sauce, and it didn't work. So Cummins engine got its price target raised to 710 from 630. Cummins is part of the North American truck market, heavy-duty engine maker. Caterpillar and Cummins are pretty similar companies, but Citi took its price target on Caterpillar to 905 from 785. Remember how earlier I was talking about Williams-Sonoma being an income stock with some growth? I look at Caterpillar and Cummins being the same kind of names. Analyst Andrew Boone at Citizens is talking one of my favorite things, total addressable market. AI is expanding the search market, and there's room for both OpenAI and Google to meaningfully grow search revenue without extending AI search with instant checkout or agentic actions. He believes earlier in the shopping journey or consideration-based queries are helping make search broader and also more incremental. Total addressable market. This is enabled by the way better understanding of queries, and we believe it's leading to an acceleration in query growth overall. So he likes both OpenAI and Google and doesn't see it as too big of a problem. The category is about $140 billion big each year. Search is about $217 billion. So the agentic search versus the you individually searching. So that's going to expand the search market, total addressable market, by about 41%. Netherlands has granted the first European approval for Tesla full self-driving with supervised use on roads and highways. Last weekend, the Netherlands approved the use of Tesla's self-driving software with required human supervision on highways and city streets. It marks the first country in Europe to grant regulatory approval of Tesla's full self-driving to allow autonomous vehicles on European roads. The approval was granted by the Dutch Valley Authority after 18 months of testing and mapping analysis. Tesla continues to target expanding full self-driving more broadly throughout Europe in 2026, pending regulatory approval. Their vehicle sales that they pre-announced in the first quarter of 2026 were below sell-side expectations by about 7,000. They came in at 358,000, 7,000 light. Tesla also announced it's deployed 8.8 gigawatts of energy storage products in the first quarter of 2026, well below the sell-side consensus of 14.4. Still, Tesla is working the Cybercab, the Tesla Semi, and the Megapack 3 to try to get in volume production this year. It's also currently developing its first volume production lines for its humanoid robot Optimus. Deliveries maybe second half of 2027. Competitor to Tesla called Slate, and when I say competitor, it's an EV that's cheap, $25,000. They just closed $650 million Series C funding round. It's giving the company operational capital to reach the next stage of development. It has over 160,000 reservations, up from 150,000 in December. It's on time and budget to deliver its first mid-$20,000 electric truck by the end of 2026. Mark Moderler talks about Microsoft this morning. He's an analyst at Bernstein. He says there's concern that AI is not good for Microsoft. He wants to discuss this bear case and the ways Microsoft could be allocating CapEx, showing that the most likely scenario is Microsoft is one, mostly increasing capacity that has a greater than 6-month delay from when it is spent until revenue starts to get captured. It's investing more in its first-party apps, which is good margins. And it's using more capacity for training models, but not impacting research and development margins. Asia growth should accelerate in the third quarter and be strong, if not stronger than fourth quarter. I'm sorry, fourth quarter is going to be stronger than the third quarter. And third quarter is looking good. The Microsoft is investing in internal use, especially model training, but research and development as a percentage of revenue is relatively stable. The Asia margins are going down, but that's due to a combination of a mix to lower margin AI, which will resolve itself as Asia AI margins improve. One combination of a mix to lower margins with AI will resolve itself. There's a timing delay between the CapEx investment and the capacity being available to drive revenue growth, and investors are not taking that into account. He models Asia revenue should accelerate in third quarter and be stronger in fourth quarter as well. So he's finding some love for it, and stocks moving higher today on his note. I love software stocks. Dead cat bounce. I don't know. The iShares expanded tech software. This has been a big story this year. It's catching a bid. The ETF is ticker symbol IGV. The VanEck semiconductor ETF, ticker symbol SMH, is trading roughly flat. So software is like seeing its day over semiconductors. Workday's up 5%, ServiceNow up 6%, App 11 up 7%, CrowdStrike up 5%, Atlassian up 4.9%, Palantir up 4%. Big gains to start the week. In the last 5 sessions, the semiconductor ETF outperformed its software counterpart by whopping 18.4%. Software's best ever 5-session stretch relative to semiconductors came in early March when traders were digesting the U.S.-Israeli attacks against Iran. Goldman Sachs is looking at some non-software growth stocks. I always like those peculiar little research notes, non-software growth. Despite weathering the market shocks from the war with Iran relatively well, software remains down sharply. With the iShares expanded tech software ETF, IGV, down roughly 30% this year. And look at the calendar, it's only April. So Goldman wanted to run a screen of non-software growth stocks that have notched 10% sales growth in 2024 and 2025 and are expected to do the same through 2028. Some of their names are Broadcom, AMD, Advanced Micro, Vertiv, ticker symbol VRT, Arista Networks, ANET, NVIDIA, as well as some others like DoorDash. Year-to-date return, like on AMD, is 10%. Its PE is around 30. Sales growth in 2026 is expected to be about 35%. Sales growth in 2027 about 42%. Broadcom year-to-date returns 3%. PE is roughly 25. Sales growth in 2026, 74%. Sales growth in 2027 is 44%. So the names that they find value-oriented typically aren't doing great this year, except for one. Vertiv Holdings is up 78%, PE of 43 times earnings, but it's expected to grow 33% and 22% in 26 and 27. Micron's got a PE of 5, but its expected sales growth of 2026 of 230%, and then 2027 another 33% on top of that. The name that stands out the most to me on this list, Broadcom and Nvidia. They look like no-brainers for a trade. Nvidia is down 1% for the year, but its PE of 21 is less than the S&P 500. Sales growth for 2026 is supposed to be 71%, and sales growth for 2027 is 32%. The law of big numbers. Netflix is going to report numbers on Thursday. It's the first quarterly report since Netflix walked away from its $82 billion deal to buy Warner Brothers, Discovery streaming and studio operations. That distraction's gone. Now we're back to guessing how long Netflix can keep growing at its recent annual pace of around 15%. Well above Disney, which grew about 8%, and Warner Brothers Discovery 5%. Netflix forecasts 15.3% top-line growth for the first quarter, but 12% to 14% growth for the full year. Pretty decent numbers. Netflix forecasts ad revenue would double to $3 billion this year. Out of total revenue, it projects will be as high as $51.7 billion. The streaming ad market's not huge at $37 billion in the United States this year, compared to $133 billion for U.S. social media, and the market is extremely crowded, with everyone from YouTube to Amazon to Disney to Warner Brothers Discovery jockeying for market share. They just announced price increases again, which just feels like, ouch. Another $2 for most plans. I've got a big segment coming up for you in just a minute, but I want to end with this segment on Generation Zers and some millennials are investing their extra cash. The number of 26-year-olds who've moved money into investment accounts, not including the 401ks after turning 22, jumped from 8% in 2015 to 40% in May of 2025. The biggest factor is that most of these young people with extra cash are still priced out of buying a house. The share of American home buyers aged 18 to 39 dropped from 51% to 44% last year. So instead of putting money towards a home mortgage, they're putting money into savings. I'll take it. I think that's good news, but it comes on the back of some very, ouch. Are we going to create wealth again in homes for younger people? It's a great way to create wealth over time. It's a lot of liability, but it's a great way to create wealth over time. Let's take a break here. Come back with a strategy segment. I have a Pints and Portfolio coming up this Saturday, 11:30 to 1:30 in Sunnyvale, California. We've got a few seats left. It's a good opportunity for you to answer a couple questions. We'll ask a couple questions. You could ask us a couple questions on financial planning. I'll explain how my family uses it. I'll bring two financial planners, Ryan and Julie from EP Wealth. All the details are at robblackshow.com. It's robblackshow.com under the word events tab. Sign up for it. I hope to see you this weekend. robblackshow.com. It's robblackshow.com.
For more information about EP Wealth, visit robblack.com. That's robblack.com.
The biggest threats to wealth typically aren't in the stock market. It's the quiet risk that can derail even the best financial plan. Financial planning conversations tend to orbit around markets, what stocks to buy, how to allocate assets, when to rebalance. Advisors build sophisticated portfolios designed to weather volatility, minimize costs, and capture long-term gain. But here's the uncomfortable truth. For many investors, the greatest threats to wealth aren't market crashes or bad investment picks. They're life events. They're blind spots. Decisions deferred too long, risk hiding in plain sight. Divorce, longevity, taxes, and estate planning failures. These are not flashy risks. They're not fun. They don't show up on a ticker, but they can quietly erode or outright destroy decades of disciplined investing. I've seen it happen numerous times to other people who have asked me for help. Increasingly, advisors are realizing that protecting wealth requires just as much focus on these non-market risks as it does on portfolio construction. Divorce is the financial earthquake few truly plan for. Divorce is often treated as a legal event. In reality, it's one of the most complex financial restructurings a household will ever experience. Assets are split, income streams change, tax profiles shift, retirement assumptions are reset, and in many cases, the lifestyle that was supported by one household now must be supported by two. The math alone is unforgiving. A couple living comfortably on $250,000 a year may find that post-divorce, neither individual can maintain that lifestyle independently. Housing costs double, insurance costs rise, investment strategies must be recalibrated. The spouse stepping into financial leadership midstream is forced to make high-stakes decisions without years of accumulated context. That's a vulnerability. There's the emotional overlay as well. Divorce is rarely a purely rational process. Decisions are often driven by urgency, stress, or desire just to be done. Divorce planning shouldn't begin at separation. It should be embedded into financial literacy and shared decision-making before it becomes a possibility. EP Wealth has divorce specialists for when this happens to wealthy couples. Longevity is another big issue. Living longer, it can be the surprise hit. That's a good problem to have, but financially it introduces a level of uncertainty that most plans underestimate. Retirement used to last 10 to 15 years. Now it can last 25 to 35 years. That dramatically increases the risk of outliving your savings, facing extended periods of market volatility, encountering large, unpredictable healthcare costs, and increasingly, retirees just aren't supporting themselves. They're supporting others on both ends of the generational spectrum. Aging parents may require long-term care, assisted living, or in-home support. That's $100,000+ a year. At the same time, adult children may be still financially dependent, whether due to student debt, housing costs, delayed career stability, or even that divorce that we were just talking about. This creates what's often called a sandwich generation effect. Financial pressure from above, your spouse that's aging into long-term care, and financial pressure from below, your children who haven't quite hit their success financially. A lot of people forget about medical costs in retirement. They're expensive. Extended care is the obvious one. It's going to cost you $100,000 annually, and that's at today's prices. Think about the future. People assume they'll remain healthy, they won't need extensive care, that family will step in if needed. Longevity risk isn't just about living longer, it's about funding a larger, longer period of time that's more complex with a web of dependencies and uncertainties. The estate planning mistake that people overlook as a challenge or a pothole in retirement can derail your finances. Many people treat estate planning as a one-and-done exercise. It's a mistake. They draft a will. In California, you should draft a trust. Check that box. Move on. That's what I see a lot of people do. But estate planning is not a document. It's a process. The biggest risks often emerge not in the creation of the plan, but in its execution. A well-drafted trust means little if assets aren't properly titled into it. Beneficiary designations are outdated. Trustees are unprepared or ill-equipped. There's no coordination amongst legal, tax, and financial advisors. Another reason to work with financial planners is they talk to my estate planning attorney. They talk to my CPA tax accountant. It all works together. I mentioned trustees are unprepared or ill-equipped. I think naming a member of your direct family to be the trustee is a huge mistake. I've seen it tear families apart in the sense that you nominate your favorite son, but you have 2 or 3 sons and 2 or 3 daughters, or you get the idea. And then favoritism starts to come in, and I've seen people ripped off. I've seen wishes not fulfilled. I've seen people get angry and never talk to each other. It doesn't provide immediate gratification. It can be expensive, estate planning, and it forces uncomfortable conversations about mortality and family dynamics, so it gets delayed. But many estate planning opportunities, particularly those involving tax minimalization or wealth transfer strategies, must be implemented well before death. Once that moment arrives, your options to do it over are gone. very limited. Estate planning isn't about documents. It's about coordination, communication, and continual maintenance. Another permanent wealth destroyer is taxes. Markets losses are visible and they're often temporary. Taxes, by contrast, are quieter but permanent. Every dollar lost to inefficient tax planning is a dollar that can't compound. I was able to cut my tax bill almost 80% this year by doing tax efficiency planning with a financial planner team that helps implement the strategy for me because it's beyond me. Tax strategy is often underemphasized in financial planning. Many investors accumulate wealth in tax-deferred accounts like traditional IRAs and 401ks, only to discover later that they've created a future tax problem. Required minimum distributions, RMDs, can push retirees into higher tax brackets. Social Security benefits may become taxable. Medicare premiums can increase due to higher reported income. The result is a cascade of unintended consequences. Lack of tax diversification is a common issue. I see it all the time. Too much in pre-tax accounts, too little in Roth accounts, insufficient taxable, flexible assets. This limits strategic flexibility in retirement. Advanced strategies like Roth conversions, tax loss harvesting, and direct indexing can mitigate some of those risks, but they require proactive planning, often years in advance. The key insight is simple but powerful. Market volatility is uncertain. Taxes are guaranteed. Tax planning isn't a once-a-year activity. It's a lifelong strategy once you hit 50 plus that directly impacts net returns. I have an event coming up. Pints and Portfolio, Sunnyvale, California. April 18th, Saturday, 11:30 to 1:30. Sign up for the event at robblackshow.com.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.